What is a union budget? A union budget is a financial statement of the government. It is a plan of expenditure, or spendings, by the government and how it proposes to fund it. A government has to spend on defense, government organization and employees, police, judiciary, infrastructure and other development projects in the country. In addition to social welfare programs related to employment generation, health, education, the government subsidizes essentials like ration, gas and occasionally even energy to help weaker sections of the society. To fund the expenditure, the government primarily raises resources through levy of direct and indirect taxes. Direct taxes relates to tax on income of individuals and corporates, whereas indirect taxes related to manufacturing and import of goods and services. Government also receives income through capital receipts, which is loans raised by the government from public, Reserve Bank and other parties through sale of government bonds. In addition to giving statement of account to Parliament, the government also presents its fiscal policy in the budget, which essentially highlights the focus areas of spending and growth direction of the economy. How is union budget made? Before budget, the government meets industry leaders to understand their demands and recommendations. It picks signals about the health of various industries by holding discussions and through other economics and statistical tools. Based on these discussions and findings, it comes up with probable solution. The government also presents an economic review document before the budget, which outlines the health of the economy and the steps that the government intends to take for sustainable and inclusive economic growth of the country. Why is union budget important? As citizens of India, union budget is one of the most important announcements by the government that impact us. It impacts industries by the perks, subsidies, tax holidays and applicable direct and indirect tax rates. For individuals also, it impacts us through the direct and indirect tax proposals. The lower these taxes, the lower the costs. However, it also means lower income for the government, thereby impacting the ability of the government to spend on social welfare schemes in the area of health, employment, rural development and supporting weaker sections of the society. What is fiscal deficit? Fiscal deficit is the gap between government's total spending and the sum of its revenue receipts and non-debt capital receipts. Since expenditure tends to be higher than income, the government has to depend on borrowing funds from financial markets. Basically, fiscal deficit represents the total amount of borrowed funds required by the government to completely meet its expenditure. When is the next budget announcement? The budget is conventionally announced on the last working day of February. It is done so that the Lok Sabha has the month to review and modify the budget proposal. What should investors look for in the budget? From investors' point of view, the better health of central government and improving growth outlook for economy would essentially result in healthy corporate earnings and a vibrant equity market. Also, investors could look for key focus areas where the government has increased spending allocation to get an idea of sectors or pockets of companies that would benefit from it. For example, the huge capital spending outlay for railways in last budget boosted growth outlook for companies, their suppliers of goods or doing contractual work for railways. Normally, the indirect tax proposals tend to impact profits of certain companies. For example, a steep increase in excise duty on cigarettes in last budget adversely impacted profitability of ITC, the largest tobacco company in India.